Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, Alphabet announces big plans for spending. We'll get a read on the state of the AI trade and big tech earnings. Plus, Bitcoin plunges below $70,000 per token. We'll have full analysis on it ahead. And we'll discuss the state of the healthcare industry with the president and COO of Cigna and the CFO of Cardinal Health. But first, we got to get a check on what's going on today, because we still are seeing significant selling pressure across the board here today. Right now, the Dow is off by almost 350 points, about 0.7%. The S&P 500 down 0.9%, and the Nasdaq down about 1.1%. And we are continuing to see heavy selling pressure within technology here. You see what's going on with Alphabet. After that company came out with ambitious spending plans for this year, we're going to dig more into that in a moment. But the 3.5% decline that we are seeing for this stock, of course, is on the back of a major run higher that we have seen for Alphabet, up 67% over the past year. So even though most of Alphabet's numbers beat estimates, right? And we talked to an analyst earlier who still has confidence in the stock. You see a bit of a sell-off there. Something else worth mentioning here is Amazon shares are also trading lower. Over the past year, they've gone more sideways to slightly down. But today, they are off about 4.4%, and that company reports its earnings after the close. So the pressure here is kind of on. And then we got to go over to software and see what's going on there, because we are seeing pressure once again on these software companies, continued pressure. There doesn't seem to be much abatement of it, and that's as we get news that OpenAI is rolling out yet another tool, this one called Frontier, that is aimed at enterprises. That's one of the things, these new product introductions from both OpenAI and Anthropic, that have really caused a lot of selling pressure within these stocks. Let's just take up Salesforce as one example here. Now, the stock is down 3% today. If you look over the past year here, you see that sideways to down movement, down 44%, and especially this latest leg down that really mirrors what we have seen more broadly within the software sector. I mean, Microsoft, even though Microsoft, its numbers looked decent, right? It's spending a lot too. It has not been immune to that selling pressure that we have been seeing. So we're going to continue to watch this trend. Palantir, even though many analysts sort of see it as not a typical software company, and its earnings that we just got showed that it was strong, it has not been immune either. So really, this has been a broad-based sell-off. By the way, just quickly, before we move on, got to talk about what's going on in crypto. We're going to dig more into this with our Jared Blikre in just a moment. But here's another one-year chart that is definitely not a fun one for the bulls, right? You've got this big drawdown now of more than 40%. And when I talk with Jared in just a few minutes, we'll be talking again about levels to watch and what some of the predictions are out there of how much lower Bitcoin could go. We got to talk about another stock, though, right now, and that is Qualcomm, because those shares are also under heavy selling pressure after its revenue outlook fell below the street's expectations. Angelo Zeno's joining us now, equity analyst at CFRA Research. You got a buy rating still on this stock, Angelo, but there was a lot of disappointment here, particularly in the company's bread and butter smartphone business, which is under pressure because of the inability to get memory chips into these phones. So, this really seems to be a big challenge for the industry overall. How bad is it, do you think, and how long is it going to last?
Yeah, Julie. So, thanks for having me. It's pretty bad right now, right? I mean, you kind of look at how constrained we are. I mean, you kind of laid it out nicely, but you think about where all that memory demand is going right now. Look no further than Alphabet's results last night and the boost in CapEx plans, right? That's really the issue at hand right now. It's the fact that you're getting all this memory capacity really kind of devoted to the data center AI infrastructure builds. And as a result, if you're on the PC on the smartphone side of things, you're getting hit really hard. When you look at what's happening with Qualcomm here on a sequential basis, you're looking at handsets dropping north of 20%. Let's call it about nearly 13 to 15% on a year-over-year basis in terms of decline. The good thing is we've now seen this reset on the expectations, and you kind of look ahead. It's likely going to remain pretty weak here. We'd say over the next 6 to 8 quarters at least, as far as the memory bottlenecks are concerned, before you really get any notable help. And again, that's gonna hurt Qualcomm, especially given that they do have a lot of business at the low end of the channel where a lot of those pressures are being felt. On top of that, they are losing, ongoing Apple business, which continues to wind down. So they're hitting it all over the place in their core business. The good thing is they are diversifying, and that really is the core story here. If you are a bull, you're getting a very value, cheap play here with a long-term trajectory in terms of new emerging markets.
I guess the question is there, how long term? Like, how long do you have to wait, Angela? Because if you look at those other sources of revenue, right, which have been growing quickly, and that has been the company's whole strategy. For example, the automotive business, $1.1 billion in revenue in the quarter, so it broke above $1 billion for the first time. But phone revenue is almost $8 billion. So, you put all those non-phone things together, how long is it going to take for it to ramp up?
Yeah, it's a great question. And what I would say here is, listen, the bad thing about being a value investor or looking at value names in the tech space is sometimes it takes longer than you want to wait, right? And as far as Qualcomm is concerned, what we've told investors is you have to be patient with this. I will say this, so last quarter, let's call it about 26% of their revenue within kind of their manufacturing, chip-related manufacturing business came from non-handset revenue. Given the plunge that we're seeing here in handsets this quarter, let's call it about 35% or so of their revenue will come outside of handsets. And we do think within the next 2 to 3 years, that number grows to at least 50%. So on the top line, you may not see much growth there. Not to mention there is potential upside to our expectations. For instance, they are getting in areas like data centers where if they were to announce some big customer wins, that could provide upside, right, to expectations. So I'd say at this point in time, the valuation plus the fact that, hey, listen, there is line of sight here over the next couple of years. And I know, listen, nobody wants to be talking about 6G because that's towards the end of the decade, but that's also, another opportunity for the company long term. So there are opportunities out there, especially when you look at the valuation. You've got to be patient if you're an investor.
So I am curious then, Angela, if you're looking at Qualcomm versus some of the other chip makers, particularly say a Broadcom right now, yes, obviously you're saying you want to own this name, but is there other stuff where you're seeing maybe more opportunity in the short to medium term?
Yeah, I mean, listen, I think, this is a really interesting market right now. I mean, I think you kind of started off talking about some of these software names, and, there are other type of names, that we have really been punished here over the last couple of weeks within the tech arena. And I think the concern really is kind of what does the tail look like in a new AI-induced environment? Not necessarily what's going to happen in 2026, because the earnings trajectory looks pretty good for tech in this year. It's more along the lines of what's going to happen, beyond 2027. And when we start looking at maybe some of the tails with the companies within semis that may have a longer tail, I would look at a name like an AMD that just got punished here yesterday. I know it continues to be beaten down here, but it's a name that we think will turn around and has some really good opportunities tied to them as they start getting into these large-scale rack solutions. I do understand the fact that, hey, listen, can some of this CapEx momentum be sustained and maybe avoid, some of these other AI-type plays? But AMD is one where I think you can get that AI play and maybe, that long tail tied to it.
Angela, you also cover Alphabet, so I got to ask you about that one because there, too, we are seeing some selling pressure. How much of it is what we heard from Alphabet? How much of it is the concerns you alluded to, right? The bigger concerns that seem to be plaguing tech right now.
I think for Alphabet, listen, I mean, it just had an insane run here going into the print. I mean, it's trading at about a 25% premium to Microsoft. So you've got that, going against them. Not to mention on top of that, that CapEx number was absolutely monstrous. I mean, they're essentially pointing to a doubling here year over year. That's going to really destroy the free cash flow expectations here over the next couple of years. So essentially, virtually most of the cash from operations at this point in time being reinvested in that business. So don't expect, any significant buybacks if you're an investor in this name. But that said, listen, that backlog growth that we're seeing from Alphabet really kind of warrants higher spending. So we'll see how this all plays out here over the next couple of years. But if they make do in terms of their promises from this higher spend, there's a really great growth story here to be looking at over the next 2 to 3 years.
I mean, Angelo, in general, do you think that this sell-off that we've seen more recently in tech is really giving a gift to investors who want to add to positions or enter positions?
I think a market like this gets very dangerous in the sense that, it's not necessary. You're not necessarily seeing the pullback here due to some adjustment factor in terms of earnings. It is, again, that long-term unknown as far as we kind of transition to this AI world. What I would tell investors, and I think what most people would agree with, is you do have to be a lot more selective in this type of environment. You do have to look at names that say, hey, listen, where are stories that can continue to grow in an environment here 3, 4, 5 years down the road, where we do have high conviction. A name like Alphabet is a great example of that, where maybe some of these SaaS-oriented names, get a little bit more difficult. So I do think there are some value traps in this market. I think there are also some great opportunities.
And you just named at least one of them, a couple of them for us. Angelo, thank you so much. Good to see you.
All right, thanks, Simon.
And this afternoon, don't miss our interview with the Qualcomm CFO on Yahoo Finance to talk more about those numbers and the company's long-term outlook. Well, we have been watching some economic data, in particular job openings, which fell in December to the lowest number since 2020. They're known as JOLTS, this particular reading. So coming in lower than expected here, about 6.5 million job openings, 6.54. But that was a drop month over month from the 6.93 million reading in November. So we're also watch things like the quits rate, which was at 2%. That was unchanged month over month. And the layoff level also ticking up a little bit to 1.76 million, that's 1.76 million. So that was an increase month over month as well. Add to that the Challenger Gray and Christmas numbers we got this morning, which showed the highest number of job cut announcements in January, specifically a January, going back to 2009. And this all adds to the increasing evidence, seemingly, that the job market is indeed weakening. So those two reports getting a lot of attention today. Coming up, the crypto sell-off is also gathering steam as the token drops below 70,000. We'll have more on the outlook coming up. Bitcoin plunging below $70,000 per token as the unwind in crypto continues, and prediction market traders are betting on more pain ahead. So let's get the full outlook for the token with Yahoo Finance markets and data editor Jared Blikre. Jared, you and I have been talking a lot about this lately. We've been watching it. 75,000 was your level.
Yes.
Obviously, it went below 75,000.
Yes.
Well below 75,000. People on Polymarket think it's going to keep going down. So,
yes, right there.
Yes, exactly. Okay, so what are you seeing in the charts?
75,000 was a very important technical level. It was the low from last year, that's 2025. It was also the high from 2024. And so that was kind of my line in the sand. And I said, if it starts kind of probing below that level and then it acts as resistance, here's a chart. Let's just put the 5-year up there.
Oh, well, hold on. This is the bind.
Oh, good catch there. Let's put Bitcoin, because they do look kind of similar here. And let me just take it down to a 3-year. So as I was saying, we got the highs of 2024, we got the lows of 2025, and now we are below them, and solidly so. That's not even close. So what I said is that's probably crypto winter. And the beginning of it was actually up here, although we didn't know it at the time. And I keep hearing analysts talk, and credible analysts, about the 4-year cycle. And I know you've talked, and you've read the same 10X research here.
Yes, exactly. So 10X research, you and I both read the report this morning, and they're talking about a potential low of 40.
Yes.
And they say that's not going to happen in the short term. They're looking more towards sort of September. FIFA, I think the World Cup is like their peg for it.
I looked that up. So that's mid-June to mid-July. And so that would be the beginning of the window. And I think September would be the end of the window. So we've seen this cycle play out before. Let me put a 10-year chart so I can show you what happened over the last crypto winter. So here we had 20 to 2022. We had this double peak here, and then it took a while to find a bottom. We eventually did, but then it's off to the races. Here we have a little bit of a different structure here, but a double peak, and it looks like, if you extend this line, we'll we'll have that bottom maybe sometime in the fall, or maybe as early as summer. But I was talking to Mark Newton on an episode of Stocks in Translation. He's the top technical strategist for Tom Lee, and specifically mentioned the 4-year cycle, which I thought was interesting. And let's take a listen to that.
I don't sense it would go down 80%. Personally, I think it's going to be capped. I think Bitcoin, in my own view, goes to 60, between probably 60. High 50s, 60. I don't think it's going to be a straight shot.
So he's not quite as pessimistic.
Well, he did say it could dip into the 40s. So I'm not hearing anything about an 80% wipeout. So I guess that's the good news. And the other good news is that Bitcoin is very cyclical. We've seen these cycles play out before, and so you just got to kind of hold yourself right here if you're a holder, or if you want to buy, just wait a little bit.
Well, what I thought was really interesting about that 10X research report is the whole industry. I mean, you and I have been talking to people in the crypto industry for a while. They were so excited about institutional adoption. It's going to become more normal for people to hold Bitcoin. Well, guess what? That's a double-edged sword, because when it starts going down, those institutions are not necessarily willing to step in there because we don't know how much more it's going to go down.
Right.
And they are buying and selling in more size than a retail investor.
I think the bottom line too is we need kind of a new catalyst. Web3 was, it's kind of petered out, and I've looked into the venture capitalist markets. They're not able to fund projects the way they were in the past. They're just not attracting investor capital. So there needs to be a new thesis here, some kind of, maybe the technology hasn't even been invented yet. Maybe it integrates with AI in some way, but the old paradigm is kind of dead here. 2025, the most bullish year in terms of financial regulation for Bitcoin ever, and we didn't really see that much.
Well, and that suggests that the Clarity Act, which the industry is now pushing, including and sort of led by Coinbase's Brian Armstrong, which will clarify more of the pipes and the regulation around crypto, that suggests that even if that does get through, it might not be a very long-term catalyst.
No, I think we need new tech. That has to be the catalyst here, but that's just my personal opinion.
We'll see if it happens.
All right.
Thanks, Jared.
Thank you.
Good stuff. And you can find crypto predictions and much more by going to the Yahoo Finance Predictions Market Hub, powered by Polymarket. Coming up, how private credit is taking a hit from the software sell-off. That's ahead on Market Catalysts. Private credit firms have taken a beating in the middle of the AI sell-off. Private equity exposure to loans to software companies has flourished over the past decade. Yahoo Finance's David Hollerith is joining me, and coincidentally, or not coincidentally, that's why you're here, the companies report, some of them are reporting their numbers today, and this was a big topic of conversation.
Yeah, so obviously that the sell-off in software stocks this week has weighed on these lenders. Private equity and private credit, we're going to focus more on private credit in this conversation, is just has high exposure to software companies. And historically that has been great for them.
They've lent money to these companies, basically. That's the form of the exposure.
And the thought that software companies could be displaced by AI is obviously not something that is new for these private lenders that have given loans to them, but it's come to the forefront this year, this week, especially with the technological advancements that we keep seeing day by day. And so right now, all investors are trying to figure out exposure, and these executives at Blue Owl and also Ares Management and KKR, they're effectively trying to calm investor fears. Now, the one thing I'll point out is that some of these firms have disclosed their exposure to software companies. Others have not yet. They might through the day. Ares Management actually said that they have less than 9%, which I would assume 9% exposure of its total credit, private credit portfolio to software companies. So we're really just trying to get a feel for what that looks like right now. On the other side of the equation, though, the thing I'll point out is that financial sponsors for private equity they're a huge part of the deal market. And so if they're having a harder time getting rid of positions in software companies, that can absolutely influence what the deal market looks like going forward.
I mean, it's also really interesting because the companies that are the most concentrated in enterprise software are actually privately held. I'm talking about Vista Equity
Yeah.
and Thoma Bravo, both of which are almost exclusively enterprise software owners, but they're private.
Absolutely.
So you have to wonder also what kind of effect what's going on there is having on the markets overall, and then the ripple effect to some of these publicly traded companies.
I've spoken to a banker about those particular companies, those kinds of companies that are private and holding these loans, and they said that effectively loans and equity positions, they said effectively some of them aren't sure what to do right now, and they're just trying to figure out a strategy, and a part of that group is actually saying, let's figure out a thesis, and if we can get one, let's back the truck up. Because obviously the software situation right now it's pretty opaque and vague what companies will be disrupted and which ones will effectively AI themselves out of the problem.
Right, and it's very interesting also to see that the software declines are not really stopping, and that in this private credit and private equity space, that investors are not being reassured, right? The stocks are still falling.
Absolutely.
Yeah, so we'll continue to watch this space. Thanks so much. Appreciate it, Dave. Well, Charles Schwab is betting on younger investors. Yahoo Finance executive editor Brian Sazia spoke to Charles Schwab CEO Rick Wurster about the latest in investing trends.
Rick, good to see you again here, live in the flesh, Yahoo Finance headquarters. So it's been a busy, month and 2 weeks start for markets. What have you seen with your customers on the Schwab platform?
Well, they're very engaged. We thought they were engaged last year in 2025. Trading was up about 30% last year versus 2024. They've been even more engaged in 2026, and for good reason. There's been a lot happening in the market, whether it's been Bitcoin and some of the unwinding of that trade, certainly some of the AI stocks and software, gold and silver. There's just been a lot of themes in the market, and our investors have been very engaged in that. I always
live in two different worlds when I talk to you. One, I'm asking you for thoughts on the market, but you're like this here with Schwab. So I got to ask you about the business, but I do have to ask you about commodities. We've seen this major run up. Do you view commodities like a gold? Is that still a safe haven for investors, you think?
I certainly think gold, many people think about it as a safe haven and as an inflation hedge. But the most fascinating thing to me about the recent market activity is that Bitcoin's always been thought of as digital gold. Or if you ask someone why they own it, they say it's digital gold. Yeah, and in the last 12 months, you've seen gold go up 100%, silver, I don't know, it's up probably 200 or 300%, and of course Bitcoin's down 30-40% off the highs. So that's been a little bit surprising to see. Other commodities, I think oil's pretty interesting. I always tell people when they say, "Hey, Bitcoin's 75,000," you can go buy a lot of barrels of oil for one Bitcoin. So we'll see how the commodity markets shake out, but a lot of interesting things happening for sure.
Since you took over as CEO, you and I have always talked about what you want to do in cryptocurrencies and what you don't want to do. But you have to look at the past month of activity as it pays to be methodical in this space. As a Charles Schwab?
Well, I think for us, we want to offer what our clients want, and our active traders do engage in digital assets, and they own a lot of the crypto via ETPs today. They're exchange traded products, so they're invested. But it's still a relatively small holding for our clients. We have less than 5% of our clients that have some sort of crypto holding, and typically it's less than 1% of their portfolio. So when you do 4% times 1%, there's not a lot held yet at Schwab. We'll see how it goes, but if our clients want it, we need to give it to them.
Are you more hesitant to making a bigger push into crypto given where prices and the volatility that's come back to the space?
Well, I think we want to take the long-term view on crypto. There's a lot around crypto. There's Bitcoin, which again, people view as this digital gold. Then there's all these digital assets that are sort of utilities. And if tokenization picks up and people are using the protocols on top of the blockchains and the gas fees associated with those create value in some of these digital assets. And we need to have a platform so people can participate in that over time. So we want to participate. I think you've got to take a long-term view on this. We'll see how it plays out, but it's 50% volatility in Bitcoin. Anything can happen. You need to expect that.
But isn't it good? At least for today, your stock is up year to date. Robinhood is down over 40%. Coinbase is under pressure. Isn't it just Wow. Okay, I'm glad I'm not really even involved in here.
Well, I always think in markets, whatever your perspective is on Bitcoin and whether it's going to go up long term or not, I think it's really healthy to have pullbacks in markets because you exchange the holders of that from so-called weak hands, which might be in it for their friend bought it, they feel like they need to own it, to strong hands who are in it for a particular reason. And I think in periods like this where you're getting people flushed out of the market, you tend to end up with stronger holders. So that's probably a good thing for the asset longer term, but certainly for us as a business, this kind of environment where stocks are doing well, we're all about getting people invested in markets, the power of compounding, helping them have a plan, stick to that plan over time, and live their best financial life. And so in a market where you see equities being the backbone and fixed income doing well, that plays right to our sweet spot.
I'm coming to you to be the voice of reason here on prediction markets. What do you think about this landscape?
Here's what I think. I think there's three elements of prediction markets, and I think two of them to me make sense for investors, and one I don't think makes sense. And the first is that the prediction markets offer you insights into the probability of different events. And I think as an investor, that information is good to know about, and you want to be aware of it. And so at some point, we'll make that available on our website. Of course, you can go to Kalshi or Polymarket today and see it. The second is that there are prediction markets linked to financial markets. So if you want to take a position on what's going to happen to the inflation report, I think you can argue that's related to your portfolio, might accentuate or hedge a position that you have. And again, that's something I think makes sense in the context of investing. The third one, which we really struggle with and is counter to our mission, that's all the gambling, sports gambling. And if you look at where the volumes are, it's 95% sports gambling. And our mission is to make people better off. And people generally don't get better off in their financial life via gambling. So that's something we're hesitant to do. We'll leave that to the gambling firms. We'll leave it to the FanDuels and the Robin Hoods and others that are positioned themselves as gambling firms.
Is all of it gambling? Even if you want to bet on what the inflation print may or may not be, isn't it all just random guesses?
I think that is not an unfair statement. I think you can at least, with an employment report or an inflation report, say, I have a lot of bond exposure. If this inflation report comes in hot, I'm going to get hurt, so I want to hedge myself. So I think you can make that case, but I don't disagree. It's still, there's an element of gambling in both of those.
How could Schwab do something like this better and safer?
Well, I don't know that you can make sports gambling safer.
Well, even outside of that, even like
the prediction markets?
Yeah, prediction markets.
Well, I think the main thing is to give our investors the information. One of the great things about our platform is we try to do everything to put information at our clients' fingertips that are going to help them make the right decision. We start with a financial plan, a long-term perspective on what it's going to take for them to succeed. And then as they're making their investment decisions, we give them all kinds of research on equities, on markets, we provide live coaching. We have 1,000 traders every day that are picking up the phones, talking to our clients to help them make their decisions. So everything we do is geared towards getting them in the right spot. And if we were ever in prediction markets, we'd have to do it along those lines.
I think back in past 6 months, S&P 500, 7,000.
Yeah.
Walmart hit $1 trillion market cap yesterday. There's so many, I think, next generation investors entering the market, like young investors, that next generation. How do you think these sub 25-year-olds are going to influence the markets over the next decade?
First of all, it's great to see the influx of new investors. Gen Z investors are 41% more likely to invest before the age of 21 than the prior generation. So young investors are getting invested, and they're getting invested heavily. They make up a third of our new household, our new clients of the firm last year were Gen Zers. We've brought down the average age of our client by 10 years in the last decade.
Wow.
We keep getting younger and younger because we're winning with the young client. And what they love about Schwab is there's no trade-offs. If they want to talk to someone and get help, they can. If they want to walk into one of our branches in New York City here or another neighborhood across the country, we're there for them. And we still have all the digital capabilities and the platforms that you would expect that young people love to engage in. So we want to be here for them. And I just love that they're getting invested early.
I wish I was young again, Rick, because I would actually own some stocks. I own no stocks before the age of 25. So depressing.
Well, you know what? You're doing great now, and you're still a young man, Brian.
Yeah, I don't know about that. Rick Wurster, good to see you. Charles Schwab, CEO, thanks. Appreciate it coming down.
Thanks for having me on.
Coming up, Cardinal Health is raising its outlook for the second time in the past month. We're going to dig into the company's results with the Chief Financial Officer next. Shares of Cardinal Health, a manufacturer and provider of pharmaceutical and medical equipment and services, hit a record after the company raised its full-year forecast. Total revenue last quarter rose by nearly 20%. The company previously raised its guidance in mid-January. The stock's been on a tear in the past year. It's up over 60%. And joining me now is Aaron Alt, Cardinal Health CFO. Aaron, glad to have you back on the program, especially after seeing a quarter like that. Thanks for being here.
Well, thanks for having me. Momentum is really the Cardinal Health story today. As you pointed out, we released a strong set of earnings this morning and raised our guidance again. We've been blessed to see strong operating profit growth across all 5 of our operating segments, and that's really being driven by 2 things. One, strong demand really across the healthcare ecosystem that our business serves. We're really the beginning, the middle, and the end of the healthcare system, and so we're seeing that strong demand, and that's been matched by the Cardinal team and really strong execution in support of that demand, and so we're really pleased with the results for the quarter.
Aaron, talk to me about specifically what gave you the confidence to raise that forecast for the second time in 2 months. You said you're seeing strong demand. Where is that strong demand coming from specifically? Mm-hmm.
Yeah, we are seeing strong demand across the portfolio. Our largest business is our pharma and specialty services and solutions business, which is a combination of the old school distribution of pharmaceuticals, as well as the MSOs, as well as specialty distribution, as well as biopharma services. And so we're really seeing patients leaning in, getting the healthcare they need, doctors prescribing the pharmaceuticals that they need, and the services that we're increasingly providing really being in demand. So that has certainly helped. We have 3 businesses which we affectionately call other growth. Our nuclear precision health business, our OptiFreight logistics business, our direct shipment to the home business, and for healthcare services and supplies as well. All those are seeing very strong demand as well.
It's interesting, Aaron, when you talk about people taking advantage of their, taking control of their health, using more of this stuff. It's interesting because it's a little bit of a double-edged sword. If you look at many of the health insurance companies, they're spending more, right? Because people are spending more on this kind of health care. And I wonder what kind of visibility you have in how long that it will last. It's something that is, I think we can safely say, has confounded the health insurance companies a little bit, even as it's been good for you guys. How long is this trend going to last?
Well, there's an underlying factor that we have to keep in mind, which is the demographics are not changing, and that the American consumer, the American patient is getting older. And as people get older, they need more help. They are leaning into their health care. And so as we see the aging of the American population, we expect that the positive demographic trends will continue. Look, at the end of the day, it's not all about cost though as well, because if people are getting the health care they need, if they are adhering to the healthcare regimen that their doctors are prescribing, that should bring costs down, not up, because they're avoiding the secondary and tertiary treatments then.
Aaron, I'm curious, do you see the policies of this administration as more of a headwind or a tailwind at this point? Because I can think of 2 things that could potentially hurt demand. One of them is that maybe more people are paying out of pocket if they went off the Affordable Care Act, as we saw some changes in those subsidies. And the other, of course, is this announced Medicare reimbursement rate that is not as high as had been anticipated. That's more going forward. Are those going to reduce demand at all for you, or people paying more out of pocket?
Yeah, there's a couple things that we are in total alignment with the administration and Congress on, which is we are in favor of access, right? We are in favor of affordability. We are in favor of innovation. What that looks like will depend on the channel, will depend on the therapy area, will depend on the full ecosystem of healthcare. But what we are in support of, and certainly how we're talking to the administration, is how do we drive those 3 things? You got to keep in mind that Cardinal's role in the industry is as we efficiently and securely and safely move goods and provide services to the broader healthcare ecosystem. And we can do that in support of the goals that are out there.
And what about on the front of people not getting those ACA subsidies, for example? Are you seeing that filter through anywhere in your business?
Yeah, we have not seen a decline in demand, right, as a result of that. And indeed, with each change that has come through in the last couple of quarters, the question to us has been, well, is this going to cause people to change their behaviors? Perhaps, but we aren't seeing signs of that as yet.
Aaron, I'm also curious about the tariffs, right? Because you guys have talked about tariff pressures. You talked about it again in this quarter. What kind of pricing power do you have on the other side? Are you all raising prices to try to offset some of those increased tariff costs?
Yeah. Well, particularly with respect to our medical products business, what we call GMPD, right? We've been very transparent now for a couple of quarters that while we will lean in and drive operating efficiency and wherever we can avoid taking price, with the face of tariffs with tariffs coming through, we will need to share some of those costs with our customers. And we have actually raised prices in key parts of our portfolio over time, just reflecting the realities of where we are.
I'm also curious. I'm asking about all the buzzy things. So let's talk about GLP-1s, which is what could be buzzier than that. I know that you guys saw some increases in revenue and profit tied to that. Talk me through that, and especially given that there are a lot of affordability programs for those types of medications, the prices are coming down. How you're seeing that filter through?
Yeah, our revenue grew by 19% in the quarter within our pharma business, and about 6 percentage points of that growth was actually tied to GLP-1s. Now, I get a lot of questions around, well, what about the oral solids? What's that going to do from a growth perspective or an affordability perspective? And it's too early to tell. We are shipping the oral solids from a GLP-1 perspective within the industry, and thus far we haven't seen it change demand, right? We haven't seen it cannibalize the injection versus the oral solids, and so the key question will be, what do the manufacturers do from a pricing perspective? What are the access points? Is it only through the pharmacies? Are there direct-to-consumer channels? This goes back to what I was saying earlier, whereas we're in favor of access, right? There is a distributor behind virtually all of the various channels here, whether it's direct-to-consumer or the more traditional pharmacy as well. And so we're going to enable the access. We're going to ship it as efficiently as we can, and we're also in support of the innovation that the manufacturers are bringing, because ultimately we think that also enables both access and affordability.
And one more GLP-1 related question. Part of the promise, of course, is GLP-1s is that it will help people lose weight and help them be healthier so that they won't have other sort of comorbidities and other health problems that come from obesity. Are you seeing that filter through yet? Are you seeing a decrease in demand for those other things? And on what timeline would you expect that to maybe happen?
Yeah, we have not seen an increase in demand on chronic conditions, which I think is what you're asking. But there are some corollary benefits in our portfolio. We're one of the largest distributors of CGM devices, for instance, right? And you might say, well, why do you need a CGM device if you're losing weight and you're not diabetic? Right. Well, the good news is that the American patient, as they're taking better care of themselves, right, they are both going on GLP-1s and losing some weight and monitoring their health more carefully, which means that our business in support of diabetes and CGMs is also growing.
Gotcha. Interesting. And we're continuous glucose monitors for those who are not familiar with the acronym out there. Aaron, always great to catch up with you. Thanks a lot for your time today.
Thank you.
Coming up, we're sticking with healthcare. The president and chief operating officer of Cigna is here next. Stay tuned. You're watching Market Catalysts. Cigna topping fourth quarter expectations with total revenues for 2025 climbing 11% year over year. Going to send it over to Yahoo Finance executive editor Brian Stasi, talking to Brian Evanko, the Cigna Group president and chief operating officer. Stas?
All right, thanks so much, Julie. Yeah, double Brian segment here. Brian, good to see you here. Take us through the Express Scripts business. You're going through that earnings report for Cigna today. That was a big driver for you. What are some of the drivers in that business right now?
Yeah, thanks so much for hosting us here this morning, Brian. We were pleased to report a really strong quarter in the fourth quarter with our earnings per share a bit ahead of expectations. Strength across both our Cigna Healthcare growth platform as well as our Evernorth growth platform. And the specialty pharmacy business within Evernorth was a particularly strong driver within the quarter. You asked about Express Scripts, which is our pharmacy benefit services business. That continued to perform well in the fourth quarter. And it's going through a significant amount of industry transformation, as evidenced by the new product we introduced last October, which puts patients at the center. And I'm happy to talk further about that if interesting to you.
Yeah, this is was some legislation this week that is directly likely to directly impact that PBM or pharmacy benefit manager business model. What does it mean to the bottom line of your company?
So you're right. There was a landmark piece of legislation yesterday, and we agreed with the FTC, importantly, to put some legacy matters behind us and move our company forward to help transform the patient experience, specifically around pharmacy benefits. And we were thrilled to see the administration come out and support of our agreement that we announced with the FTC yesterday, saying that this puts Americans first around pharmacy benefits. And really this builds off the innovation we introduced last October, which is a new rebate-free pharmacy benefits model where patients are guaranteed the lowest possible prescription drug cost when they go to fill a drug. So whether that's the price we've negotiated with drug companies or an alternative cash pay price or their copay, whatever the lowest possible price is, we guarantee patients will get that. So it gives them the peace of mind that they're getting good value for their money. And so the additional regulations that came through this week are very much aligned to that goal of improving the patient experience and driving better value for the patients we serve.
Brian, ahead of this, I was thinking back to when I started my career, I was a stock analyst, and one of the first couple industries that I covered were the PBM industries, and as luck would have it, Express Scripts. And this industry has always been looked upon as doing bad for healthcare. And that vibe still consists today. I mean, how do you respond to this ongoing criticism of what y'all do?
Healthcare is a really complicated industry, and I appreciate that question because we get different flavors or versions of that frequently. I think it's important to step back and think about what are the drivers of the healthcare affordability challenge that we have in America right now. And I like to use just a basic demand and supply framework for that. We have increasing demand for drugs, increasing demand for medical services that comes from the aging of the population, and it comes from more and more people who have chronic conditions. So in fact, 85% of all the healthcare spending in America is associated with chronic conditions. So there's this insatiable demand dynamic that's transpiring in America. On the other side of the ledger is supply. So in most industries, when new supply is introduced, the prices come down. In healthcare, that's not the case. So if you look at hospital prices are up 220% since the turn of the century for an average hospital stay, far higher than inflation. Additionally, when new drugs are brought to market, well, often they're curative and they're great for society in total. The price of them is astronomical in some instances. So just last year, the median list price of new drugs that was approved was $370,000, which is far out of reach for most Americans. So you have this insatiable demand dynamic pushing up, and the price of supply continues to push up. So we play this important role in the middle to serve as a counterweight to those forces. But by definition of that, we're negotiating with the supply side and we're engaging with the demand side in a way that's trying to drive people to lower cost alternatives, because ultimately that's our goal. That's the mission of the Cigna Group, is to help people have more affordable health care and to improve their health and vitality going forward.
The Trump administration has really focused, Brian, this year on bringing down drug costs. When will the average household start to see these lower costs, and do you think it will be noticeable?
We share the goal of the Trump administration to bring down prescription drug costs. Affordability is the number one challenge in American healthcare. So we share the strategic intent of that. And importantly, some of the innovations that we've brought forth, even in recent months, directly speak to that. So a good example is late last year, we announced a partnership with EMD Serrano to bring fertility drugs to Americans at a much more discounted price compared to what they were able to get historically. That'll be available through the Trump RX platform that'll be coming online in the coming months.
Well, good luck in the coming quarters. Looking forward to talking to you again soon. Brian Ivanko, I'll talk to you later. Appreciate it.
Thanks for your time, Brian.
All right, Julie, back to you.
Brian, thanks.
Double Brian, Julie.
Appreciate it. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.